Should I keep cash in my portfolio? Is it a good or a bad strategy to have some portion of cash in anyone's portfolio? This is one of the most common questions that has been asked by many investors in many of the public forums that I have been a part of. The answer to this question basically depends on three different things. Let me share those in this video. I would also share what my strategy is when it comes to cash in portfolio. Watch till the end. Let me start by clarifying something. I'm not talking about any kind of an emergency fund here. Emergency fund has to be kept aside whether you really want it or not. I'm really talking about the cash as a part of your asset allocation, as a part of your equity portfolio. Right, now the first question that you need to ask yourself is, what type of investor are you? Are you someone who panics at every fall? Or are you someone who believes that now that I've invested and I don't need this money that I've invested in equity for some time, I'm not going to really watch or see the market movements going forward? Let's say if you're an investor who panics at every market fall, then it definitely makes sense to keep some part of your money in cash so that if there's an opportunity and if you're really in the right frame of mind to invest, then you should make good those opportunities. There are two benefits to it. One, it reduces the volatility in your portfolio. Two, it gives you a lot of solace to see that the market is down, but your portfolio is not as badly down. Let me talk about the second person here. If you're someone who believes that now that I've invested, I don't want to see the market at all, then you should go all in. That's primarily because market, while it goes through its ups and downs, if you're invested in the right set of asset, it generally goes up. And when you go up, you make a lot more money than by trying to time the market's entry and exit. Therefore, for you, I would suggest not to keep any amount in cash. Go all in 100%. The second and the most important part is how clued and glued are you to the market movements. If you're an opportunistic by nature, right, then it means that you can set aside some portion of your money to make good the market opportunities. Remember, market always gives opportunities, whether by falling irrationally or just by falling because of profit booking or whatever may be the reason. And if you're someone who believes that this asset is really good at a certain price, then just go ahead and use the cash that you have in the portfolio to buy it. And this is exactly what you should do if you are a tactical investor also. I'm not talking about trading here. I'm just saying you have two sets of portfolio, core and satellite, strategic and tactical. This tactical part can always be used to enhance your portfolio returns. The third part is how badly the portfolio can get impacted because of the cash holdings. We all by now know that the debt returns post-tax is extremely poor. Given that the market can go up without giving any kind of a correction or any kind of an opportunity to you, the impact cost of keeping money in cash can be very high on your portfolio. Therefore, if you're someone who believes that the cash portion will not really bother me much and I am ready to wait patiently, then okay, you can keep some cash. But if that 20% or 10% of the allocation that you've kept in cash bothers you all the time because it's only generating 2-3% post-tax, then go ahead and invest that money in the market, because market can stay irrational longer than you think. If there are no opportunities, the cash holdings can come back and haunt your portfolio returns pretty badly. Think before you take cash call as a position in your portfolio. What do? I keep about 5 to 10% of my portfolio in cash. I'm an investment manager after all. I keep a very close eye on the market movements. I'm not a trader by any standards. I don't do any kind of a short-term, medium-term day trading at all, because I believe that's an exercise which is extremely futile. It doesn't generate any kind of a return. But on the other side, I'm an opportunist. So let's say I have a stock or a fund that I'm closely keeping a track of, and then it falls, because markets that go up can also come down, providing us good opportunities, right? That is when I go all in at that point in time. So many a times my portfolio will be all in, but sometimes when the market gives me opportunities or market is in a position where it can or show sign that there is a bit of an exuberance, I go into cash, maybe 10%, at best 15%, and if the market corrects like what I expect it out to be, then I go again all in with the 15% cash that I have. I hope you found this video useful. Good luck, happy investing.